So it's been a while since I did an update on Alibaba, and as they reported their Q4 earnings or Q4 results, Q3 fiscal year for them, I should say, but Q4 or December for the rest of us. So it's probably a good time to check against the progress of the company, have a look at the numbers, and then check the investment opportunity. And the thesis is still intact. What I will say is, although the results weren't outstanding by Alibaba's standards that they had set in the past, they were pretty much expected. As you can see, the stock is down 55% in the last 365 days, sold off a further 25 to 30% in the last few months. So it's not like the market was pricing in any good or positive results for Alibaba. But what we're going to do is talk through the results, talk through the bad first of all, and look at what you need to know if you are invested in Alibaba or looking to invest in Alibaba. So the first thing that really caught the headlines was the slowest year-over-year growth that they have ever posted as a public company. So 10% growth year-over-year in revenue for this quarter. And also what was quite disappointing to see was minus 1% in CMR, which is customer management revenue, essentially the advertising revenue earned in the commerce business. And we've seen in previous quarters where profit's been down or profit growth has been in the low single digits to 10%, and management are able to blame it on reinvestments. Revenue is unfortunately undeniable when there's nothing that you can do to sort of change the revenue number except for changing real consumer demand for their products. Now, the next thing was management noted weak consumption trends in China, heightened competition and supply chain issues that have hurt the underlying margins and the growth in the core business. And essentially the number that sits behind that was 45% had shrunk to 34% in the core commerce business, which really drives most of Alibaba's results and definitely the profit. And it's potentially down to the average revenue per user decreasing by a low single digit, and management say this is mainly because they had been acquiring or focusing on more underdeveloped regions and underdeveloped customer cohorts, which really brings the average revenue per user down. So that's just something to note, probably one of the underlying drivers of the weaker results this quarter. And then the third one that I was quite disappointed with myself was cloud. And cloud was actually one of the best performing parts of the business in this quarter, posting 20% year-over-year growth. But if we compare it to its competitors, global competitors in AWS, Azure and Google Cloud, they were the worst performer. AWS grew at 40% in Q4, Azure was 32%, Google Cloud was 32% as well. So although Alibaba focuses mainly on China, it is an international cloud business as well and does have an international presence. This may just be a reflection of what's happening in China at the moment, but it was disappointing to see that they were growing at a slower pace than their peers. And just on the cloud results, we can see in this year, they had 2 quarters that were down quarter over quarter. There were quarter over quarter declines in June and in December this year, which was the first time we had seen that since they started reporting cloud numbers. So that's just something to note. We still do have this huge cloud opportunity that they speak about, obviously a 5x in 5 years in the China cloud market. This isn't going to be linear, so it isn't going to happen overnight. It is a work in progress, but we would want that growth rate of 20% to start picking up in the next quarters and years if they are going to dominate this TAM opportunity here. Now, in perspective, this might just be COVID lag or COVID hangover. If you can see here the December 2020 quarter financial highlights, this was a huge quarter for Alibaba in all aspects, and possibly due to a surge in demand through COVID. Maybe I could say it's synthetic demand for the time being. As you can see, 37% overall revenue growth in the business last year for that quarter, which was already on huge numbers. 38% in the core commerce business, which again was the biggest part of the business. 50% in the cloud computing business. So if we normalize out those growth rates on a 2-year basis, it's around 23% for the group altogether per annum on a 2-year basis, and cloud is around 35% per annum, which is about where you'd expect them to be and is a more sustainable growth rate altogether. And Alibaba aren't alone if this is the case, if this is what was dragging results in this quarter. A lot of companies that rely on e-commerce, we spoke about it in the Wix video, have said that forward surge in demand back in 2020 and early 2021 is hurting their year-over-year numbers, and they posted significantly slower growth than they did last year in the most recent quarters. Shopify, PayPal, Facebook, Wix are all examples of this that we have looked at. And others have gone ahead and said that in their guidance for 2020, growth may taper off for this year just as they get through this period. So that's something to think about. Again, as I like to say with these quarterly updates, it is just one quarter. If we look at the trailing 9 months for Alibaba, their results were actually really good on a year-over-year basis. Growth was in excess of 20%, where you would want it to be. So just remembering this is just one quarter and there could be viable reasons for the year-over-year results. Now, looking at some of the positives, and this was definitely a positive to see, user growth is still very much there for Alibaba and off of a massive base as well. 1.2 billion active customers and still growing that at 19% year over year. I don't think anyone with that scale of customer base is growing their users at that big a clip. And usually user growth comes first, and then over time with effective monetization, it leads to revenue and profit growth alike in the future. So that's something to look out for. Nearly 1 billion consumers in their commerce business for China. International growing very quickly. Almost 300 million active users on an international basis now. So still growing those users very quickly, and hopefully that will lead into revenue and profit growth in the future. Now, the next thing that was a bit disappointing just from my point of view and personally what I would have wanted from management in the situation that they were in is the buybacks. They didn't do a huge amount of buybacks in Q4, even though the stock reached its lowest level for a very long time. And you can see here that Alibaba's net cash is around $48 billion. That's if you take their total cash and back out all of the debt. That's around $48 billion, plus their free cash flow, which is north of $20 billion, gets you to around $68 billion in buyback power, if you like, over the course of a year. And with the stock trading at $110 to $170 in Q4, they only repurchased 10 million shares worth around $1.4 billion. So that's roughly 0.38% of shares outstanding. And just personally, I feel that is a bit frustrating when they have the capability of repurchasing or returning 20% or more to shareholders on an annual basis, and they'd still be well capitalized and still be able to reinvest the incremental dollars into their business and growth initiatives that they've committed to. That's only around $7 billion at the moment that they're committing to that. So they could have bought back a lot more shares, and while the stock was depleted, they could have bought back a lot of shares, a very attractive price and very attractive yield, but they didn't. So that was a bit disappointing to see. Maybe in Q1 of this year, they have bought back more shares, and actually they ended up buying back most of their shares in 2021, around $180 per share. So it just didn't make a huge amount of sense to me, and something that I'll be looking for in the next quarter and would like them to ultimately up if the yield remains as high as it is. But ultimately, we have to think about this in relativity. It is an investment that obviously you have to pay a certain price for, so it has a valuation, and everyone knows that Alibaba has been depleted and cheap for a long time now. So although these results, like I said at the start, weren't amazing by Alibaba's standards that they had set already, and maybe what expectations are over the long term, or have been over the long term, if we look at the price of Alibaba, this was probably priced in, if not even more or even worse results, should I say, for a sustained period of time. And I've just got here a breakdown of the valuation of Alibaba if we look at it in a few different ways. You can see their market cap's currently just under 300 billion. Enterprise value is under 250 billion. Their trailing 12 months free cash flow, including their $2.7 billion fine, is around $17.5 billion US dollars. Excluding that fine, it's just over 20 billion. And if we take their core business cash earnings, which is EBITDA, basically backing out all of the non-cash expenses that come with that e-commerce business, that's around $30 billion. Okay, so free cash flow yield is around 7%, 8% if we back out the fine, the one-off fine, and a 12% underlying cash yield if we take the core commerce profit number. So anywhere from an 8 to 12% normalized earning yield usually discounts low single-digit future growth in the business anyway. So 10% growth for Alibaba in this quarter was more than priced into this stock, if you ask me. It's probably why you didn't see a huge reaction to the results, and some people are seeing it as positive results. The next thing is that the current price would suggest any resurgence in growth for Alibaba once they get through this COVID lag say they get up to north of 15% again, would exceed market expectations by some way and hopefully therefore lift the stock price. But this is obviously Alibaba we're talking about, so we'll see. The other thing is the potential for the delta between this free cash flow number here and the core commerce profit number to close, so for that 20 billion to become 30 billion. Ultimately, all we need is the ancillary businesses that we've looked at previously in previous analysis. All the businesses apart from commerce aren't contributing any profit. So some of them will do well in the future and probably start making a profit or break even. But the other ones that aren't going to make a profit, if they just stop operating or any of them break even, then we should get a free cash flow number that is closer to that 30 billion almost instantaneously, but it will happen over time, if you ask me. The next thing is the distribution of likely outcomes that we're going to look at in a second indicates a market-beating IRR for Alibaba, even if the growth we've seen in this recent quarter continues for a long period of time. So that's just something we're going to look at now, the IRR calculation with some changes. We've got a base case here at the top, which is essentially 20% free cash flow growth that we were seeing before this quarter. That indicates a 32% IRR. The next one is a 15% growth rate, which is probably where consensus is at the moment in terms of people who are actually invested in Alibaba. That indicates a 28% IRR from the current levels. And then a bearish case, and I would say this is bearish, which is free cash flow growth of 10% into the future, indicates a 22% IRR. And then the worst case, obviously it's not impossible that things get worse than this, but we're talking about from a fundamental point of view, what is one of the worst cases that we could realistically see, and that is single-digit growth around 7% and a PE of only 10. This still gets us to an IRR of around 8%, which I personally think would beat the S&P over the next 5 to 6 years, just of where I see the S&P going in the future. So this is obviously dependent on a few things. This is hypothetical. These IRR calculations always are. It's dependent really on buybacks being utilised to return cash to shareholders if and when the yield is attractive. Failing that, the excess cash will just pile onto the balance sheet, and any reinvestments they want to make will help with growth of the business. And the base case up here, I know it's at the top of the IRR calculation distribution, but 90% of this number here, what essentially is the driver of results, that free cash flow number in 2026, can be achieved with what we talked about in the previous slide, is just that delta between the free cash flow number and the core commerce EBITDA today closes, right? And we get to around $13 to $14 per share in profit for the group. So just taking out the loss-making businesses or them reaching profit or break even in the next 5 or 6 years. So I think this base case is actually still very likely, and that's what I'm sort of holding out for. I think this can be achieved by Alibaba if we think about cloud kicking up again, getting past the current blip that they are in with this COVID lag. So that's just an update on Alibaba, guys. Wanted to come on here and talk about the most recent results and give you an update on my thoughts. I know it obviously divided opinion this most recent quarter. A lot of people saying that they don't think the results were that bad. A lot of people saying that they were a bit disappointed with some of the results. I wouldn't say I'm disappointed necessarily with the result. I'm more disappointed with the action that management took. I would like to see them buy back a lot more shares and also just give a bit more information around why CMR was as low as it was and why cloud was lower than the rest of their peers. But that's it for now, guys. I will have another video coming out in the week, so keep an eye out for that. I wish you all a very good weekend, and I will see you in the next video.